All right, let's talk energy now because your next guest just launched coverage of some big oil and gas companies for Wells Fargo. The report is titled, "Don't Feed the Bears, Pay Them Dividends." Sam Margolis, covering oil and gas for Wells Fargo, joining us now. Sam, welcome. On the big integrated side, you like Chevron, Exxon, and Marathon Petroleum. Why are those stocks overweights right now, even as the price of oil goes down almost every day?
Yeah, hey, thanks for having me. You're right. The environment isn't great for the sector. The oil market is, nominally oversupplied. There's risk to the downside asymmetrically, especially in the near term. So when you're in a tape like that, the objective is really to identify stocks that can grow their dividends, like the title says, through a variety of different commodity environments. And that's usually driven by, bottom-up factors, portfolio factors, more so than market factors. So the work is to, dig into these companies and find the independent catalysts that are driving dividend growth. And, you just highlighted three that we have overweight ratings on. There's a few more within the refining sector as well. And we also took over coverage of natural gas E&Ps, which is an exciting space also.
I feel like you read my mind or maybe read my notes because I want to move on to the refiners. And oil commodity analyst, he's not a stock analyst, he analyzes the commodities. His name's Tom Closes, super smart guy, tweeting out today, and I'm going to kind of summarize it, Sam, that basically you got to go back about 4 years to find a cheaper national average price for gasoline. But with where oil is now, gasoline effectively should be cheaper. You cover refiners like Delek, Phillips 66, and Valero. All these stocks have had big years. So if the price of gasoline should theoretically be lower, and you could say whether it is or not, are these companies just printing money?
Well, the environment's better for refiners than it is for crude oil. I'll say that. I'll also say, though, that the refining margin has to go up a lot to make a visible impact in a retail gasoline price. If a refining margin is, call it $12 a barrel or $15 a barrel, it would have to go up $10 or almost double to get a 25 cent per gallon impact on the gasoline price. What's really driving the retail price is inflation. Transportation costs for gasoline are indexed to inflation. So that's actually an outcome of inflation, not a driver of it, interestingly. And then also retail margins at convenience stores are up too. I cover within the major space, particularly BP and Shell, they have large convenience store asset bases, and those businesses are performing really well. That's where I actually see margins growing faster than the refining margins.
Yeah, good stuff there. And who knew with all your other talents, Sam, you also covered like gum and lottery sales. It's amazing. Sam Margolis has a few buys out there. Sam, we really appreciate your time. Have a great day. Thank you very much.